Hello and welcome to the Signia market review for the month of January. My name is Elliman and I'm an investment analyst here at Signia. Starting with equity markets, the major indices saw their worst monthly performance since March 2020, which was of course at the height of the COVID-19 pandemic. This was primarily in response to the expectations of interest rates rising at a faster pace, in the midst of continued and persistent inflation. With US inflation now at its highest since 1982, markets are now expecting nearly 5 hikes in 2022 from the Federal Reserve. Interestingly, this is compared to only 3 forecasted hikes as at the end of 2021. Delving into more detail, areas such as technology were hit worse due to rates being used to discount future earnings, whereas the likes of energy and financial stocks benefited in the rise in inflation and yield environment. Losses were broad-based, with the exception of the FTSE 100, which outperformed due to the composition of the index, primarily financial and oil stocks, and interestingly the indice trading at a cheaper relative multiple. In fixed income markets, the prospect of tighter global monetary policy weighed on sovereign bond prices as yields continue to rise globally. Specifically, US Treasuries experienced their worst month since February 2021, whilst the likes of the Italian BTP outperformed as a result of easing political risk given the reappointment of their president. Bond markets have seen shorter-dated bond yields rise faster than long-dated bond yields on expectations of tighter global monetary policy. Though, the flattening we have seen in the yield curves are highlighting concerns of central banks raising rates too quickly and slowing economic growth. Moving over to commodity markets, the escalating tensions we're seeing between the Ukraine and Russia, alongside supply chain disruptions and increasing demand, enabled WTI crude oil to see its strongest gain in 11 months. Alongside this, natural gas saw a gain of nearly 31% on supply concerns due to the ongoing geopolitical tensions between the UK and Russia. Further to this, the concerns surrounding Omicron have diminished over recent weeks, which has raised further optimism that further restrictions on mobility will be avoided, which helped a variety of commodities rally on increasing demand expectations. And finally, in currency markets, the notable outperformer is the US dollar, which hit an 18-month high as US Treasury yields rose throughout the month. This was primarily on expectations of the Fed's hiking cycle being faster than originally expected, and the safe haven demand we saw amid equity market volatility. That's all from us here at Signia. Thank you for listening, and please join us at next month's market review.